I don't think there was any reason they needed to go intermeeting. I think what we needed was confidence, and I think you hit the nail on the head here that, I mean, we didn't inspire confidence. Even in the press conference, he came out and said, this can do nothing about the spread of the virus, this can do nothing about disruption in supply chains. Those are the two most immediate things we're trying to deal with. 6 to 9 months from now, it may be appropriate to have lower rates. In this immediate period, we needed confidence, and this did not help that. There should have been other policymakers, there should have been other responses last week to start to calm this market, and it didn't happen. So I think the issue here is it appropriate, is it right for monetary policy to respond in this? No, not at all. However, no one else was responding, and now you're the one left holding the bag, and that was a bit of the issue.
There is another narrative which says that credit markets were already beginning to tighten up. Investors were fleeing risk assets. The consequence of that could be more difficulty for companies to get their hands on credit lines. This was a message to the banking industry and the financial system that we will do whatever is necessary to maintain credit lines to corporates and governments that are effectively cash flow negative right now. On that basis, was this the appropriate thing to do?
We needed to ease financial conditions, there's no question. If you look at sort of what was implied by what we've seen over the last 2 weeks, it was the equivalent of about 2.5 Fed rate hikes. So in terms of that, from a one-to-one basis, you have eased financial conditions. But I think the broader point is there were other ways to provide that confidence and ease those conditions than just coming in and slashing rates, especially in an inter-meeting 2 weeks before your scheduled meeting. That doesn't seem to have helped. I think the bigger issue, even beyond that sort of initial tightening, and I think you're right, like the credit market side of things is an important part of this, because for all of the volatility we've seen, we are not priced for a recession. And that's where you'd actually see the significant widening out of credit and equities. This is what we're trying to forestall by these sorts of emergency actions here. And if we don't get it right, that's a much bigger issue. I think that's the problem. What we saw didn't really stop that process, but it sort of put a Band-Aid on it for now.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.